Hi there. Welcome to Trading Day. I'm Lindsay Biscaya. Let's get to some of the stories we're following in the BNN Bloomberg newsroom for you. Glencore Canada has been forced to suspend all investments related to emissions production and facility upgrade projects at the Horn smelter, effective immediately. Glencore has been working with the Quebec government to secure the long-term viability of its operations in the province, but says despite efforts, the necessary conditions are not in place to allow it to proceed. Glencore was prepared to make investments totaling nearly $1 billion over 5 years, which included costs for emissions reduction. Canada's Financial Consumer Agency has fined the Bank of Montreal. The $4 million fine is for overcharging customers after failing to properly disclose fee details. The penalties relate to discounted bank accounts for newcomers, medical and dental students, and Indigenous clients. The watchdog says more than 100,000 customers were impacted between 2010 and 2024. And shares of Canadian Pacific Kansas City are edging higher today. The rail operator set a new record for shipping Canadian grain and grain products in January, both by amount and carload. CPKC says an effective crop year, winter planning, and demand forecasting helped it prepare for the month. Last week, the rail company also reached a record high in fourth quarter grain revenue driven by a bumper crop. And shares of PayPal are taking a hit. The financial tech company says Chief Executive Officer Alex Chriss will be replaced after his turnaround plan failed to meet targets and streamline the payment business. He will be replaced by HP CEO Enrique Lorez. Additionally, PayPal posted profit and revenue in its latest quarter that missed estimates due to weakness in U.S. retail spending and international headwinds. And PepsiCo shares are higher today after topping fourth quarter revenue expectations. The quarter benefited from robust demand for its sodas in international markets, as well as strength in its low-sugar beverages in the U.S. Pepsi says it's cutting prices by as much as 15% in some of its key brands, including Lay's and Doritos, in a bid to lift sales by offering more affordable products. And shares of Palantir are rallying today. That's after fourth quarter profit and sales for the tech company beat expectations. Revenue was boosted by a surge in domestic commercial operations, as well as Palantir's work with the U.S. government. The company's full-year revenue outlook also came in higher than analysts were expecting. South Korea's Hanwha may send a submarine across the Pacific this spring as competition intensifies to land Canada's submarine contract. CTV's Judy Trin has more in this report.
A deep dive into what could be the biggest defense procurement in Canada's history, the purchase of up to 12 submarines.
Because this has now evolved into a government-to-government situation. It's a big procurement. This is going to be a relationship with the winner for years, decades to come.
To persuade, the South Korean Navy plans to sail the KSS-3 submarine across the Pacific and dock in British Columbia, a journey that will take 2 months.
Your hands up here. Okay.
CTV News also got to see Hanwha's pitch up close. We couldn't film because of security protocols, but the attack submarine holds about 50 sailors. It launches vertical missiles that target land and has torpedoes. But the deciding factor will rest on economic benefits. To win the contract, Hanwha is pledging to help hard-hit businesses, like investing $345 million in Algoma to buy its steel and help it build a plant to make beams.
It's been tough as tariffs have been in place for a year and half of our business has gone away.
While some companies are hurting, others are looking for ways to expand. Using robotic technology, Hanwha builds 45 ships annually on its assembly line. Speed, Ontario's shipyards want to emulate.
I mean, what they do here is cutting edge. It's absolutely fantastic. If we can bring just a fraction of that
to Canada, I think us as a country would be a lot further ahead in our shipbuilding endeavors.
The deadline for Hanwha and TKMS to submit their bids is March 2nd. It's a deal that could be worth $100 billion spread over more than 3 decades. It's investment that Canada needs to protect itself from Donald Trump's trade war.
That was CTV's Judy Trin. And here is what's trending today. We'll take a look at some of the leaders. Energy fuels, rare earths, and critical mineral stocks are rising as the European Union is set to pitch the U.S. on a critical minerals partnership to reduce reliance on China. Energy fuels up almost 13% at the moment. If we take a look at some of the laggards, Thomson Reuters shares are falling as much as 17% today. We're watching this very closely now, 19%. Its biggest intraday drop on record after artificial intelligence firm Anthropic released a new productivity tool to help automate legal work for companies. So we'll have more on that later in the show when we talk to Rudy DeFelice, global head at Harbor Labs. We're also watching shares of Shopify as the company's Class A fell the most in 10 months. You can see it's down more than 10% at the moment. Coming up after the break, we will get you the latest on the markets as more company earnings come out. Stay with us. Earnings season started off strong in January, and we'll get the latest on its performance so far from Scott Ladner, Chief Investment Officer at Horizon Investments, who's joining us now. It's good to have you. Thanks for taking the time.
Hey, Lindsay, thanks for having me.
We can talk about earnings throughout January, but I'm not sure if there's anything today also that's standing out to you in terms of like Pfizer, PepsiCo, PayPal, Merck, all reporting earnings today. Anything in particular that jumps out?
Not anything that's really particularly interesting or sort of narrative moving. If I'm being honest, I mean, I think we kind of know what we're getting out of earnings so far. It's good, but not great. These are solid reports for the most part. Palantir, like overnight was, laid out the case for continued AI involvement. But the market's freaking out a little bit about today, about continued sort of equity issuance related to AI investment. So it's kind of a mixed bag a little bit, but nothing really, today or yesterday is really moving the needle from a macro standpoint. About the things that we're really caring about, learning about companies and learning about the consumer and AI and everything else as we come through this first quarter.
Yeah, when we're talking about AI, like we've got this kind of Anthropic effect happening today where we're seeing a lot of tech companies down because of this new AI tool to help in legal work. I'm not sure if you have any sense of what's going on there, but I know you were talking about AI and how last year was all about building AI capabilities, and the next couple are going to be about diffusing the AI throughout it, like trying to figure out actually how it works. Can you kind of dig into that a little more?
Well, yeah, I mean, look, that's kind of what we're seeing, isn't it? I mean, we're not talking as much about building of data centers and building basically of the infrastructure side, even though that's going to continue to go on and it needs to continue to go on. We still do need some more power infrastructure and everything else to make this really kind of hum. But ultimately, I mean, the thing the market is going to care about and the thing the economy is going to end up caring about more is like, how are we actually using this stuff? How is it being diffused? How are these capabilities being diffused through companies, being diffused through work processes and everything else? And this example today from Anthropic about a potential basically like legal legal GPT essentially is one of those steps. And yes, it is going to disrupt things. We want some creative destruction out of this. The destruction part's not awesome to deal with and look at, but the creative part is how you end up building more productivity into a system, and that is ultimately going to be the promise of AI. But it's going to be it'll be a little bit of a rocky road like we're seeing today.
Let's take a more macro look at the economy now and at the markets for today. You say the economy, this is an economy for 2026 that has some very strong tailwinds. So what are those?
Yeah, look, they start on the fiscal side. We're getting fiscal basically stimulus out of the government in the United States, and we know that coming from the big beautiful bill, the tax breaks for individuals. Those refunds really start hitting in the next week or two. So people are going to start having more money in their pockets to spend. We know they spend it when they got it. But there's other fiscal stimulus that comes in the form of basically private fiscal stimulus, and that's the what I spoke about a few minutes ago, the infrastructure build related to like getting AI into basically into a place where everybody China can use it. So that's the fiscal stimulus side is rather strong. We also have monetary stimulus that people have sort of forgotten about. The Fed did cut rates. Global central banks broadly cut rates over the last year and a half. But it takes some time for those rate cuts to actually make their way into earnings and to make their way into the economy. And it's usually about 12 to 18 months. And we're kind of sitting here at the cusp of that stuff really mattering. And we're starting to see it in earnings. We're starting to see it in small cap earnings, mid cap earnings. We're seeing an inflection higher in some of those numbers that you would expect to see as the economy accelerates with the impact of the monetary easing from a year and a half ago. So those are the two big ones. And then we could spend all day talking about productivity enhancements with respect to AI and kind of what that can do. But there's just a lot of tailwinds simultaneously hitting the global economy, and that is something that I think but everybody talks about one or the other, but getting this all together all at the same time, I think, is going to end up being pretty powerful.
What about headwinds as we look at 2026? What are the biggest risks you're seeing?
Well, look, I mean, one of those risks really got taken off the table last week. We thought that if Trump really pounded the table on and basically bullying the Fed around and trying to get somebody in there that would do his bidding and get rates sort of artificially lower, that could be a real problem. Be a problem not just for the U.S. but for the global economy, because you'd end up with higher rates in the U.S., a weaker currency, just a whole bunch of bad stuff that would sort of trickle through the rest of the global economy. But we didn't get that. We got sort of the anti troublemaker in that seat with Kevin Warsh. So that would probably end up being helpful. But there are a couple other things that we're worried about. Look, the calendar this year in 2026, a midterm year in the United States, is not one that's usually a great year for equity markets. So that is certainly a headwind, at markets right now. And then the other one is some of the geopolitical risk that we're dealing with. The one that you can't call it, but if China were to ever do something out of Taiwan, the military purchases have our attention out of China. The fact that China's economy continues to really struggle and sputter along. Look at the 10-year rate in China. That's really sort of the key barometer to watch. Are they actually getting out of deflation? They're sort of stuck in a deflationary trap right now. If you see that 10-year rate moving up, that's a really good sign. That means that China is getting out of deflation. But while they're stuck in this, look, leaders have started wars for sillier reasons. And if China were to do something in Taiwan, that would obviously be a massive headwind to the global economy.
Got it. Yeah, a lot of geopolitical risks and things to watch throughout the year. And it's only February. In terms of sectors that you say financials are a big one for you, at least this month.
Yeah, they are. Look, and I think actually the Kevin Warsh appointment helps us out some because we do think he's going to be a big proponent of deregulation. But one of the things we frankly got wrong last year is we thought that Trump too was going to come in and have a big deregulatory policy like he did the first go around. And really, it just was third on his list, and he never, frankly, got to it. The big, beautiful bill and tariffs were basically occupied all the space in the first year of his administration. We do think deregulation is going to come about this year, and financials, and especially the smaller and the mid-cap financials, are really the ones that are going to benefit most from something like that. You combine that with an economy that we think is going to run pretty hot in the United States, and with corporate demand picking up for loans and everything else, and banks being much more willing to lend right now, as we've seen in the SLUD surveys. So we think actually that this is the setup for financials has been pretty good, and we've been involved for a few months. But we think actually this one's got some legs. It could go on for pretty much the rest of this year.
Very interesting. Okay, that's all the time we have, so we'll have to leave it there. But I appreciate you joining us today. Thanks so much. That was Scott Ladner, Chief Investment Officer at Horizon Investments. Well, coming up next, India has inked deals with both the U.S. and the EU within the span of 2 weeks. So we will discuss details right after that. Welcome back. Last week, India and the EU announced a free trade agreement deemed the mother of all deals. And not long after, U.S. President Donald Trump announced tariffs on India will be lowered and the South Asian country would stop purchasing oil from Russia. So here to talk more about the deals is William Pellerin, partner and international trade lawyer at Macmillan. It's good to have you join us once again. Thanks so much.
Great being here.
So the deal with the U.S., obviously this was the second deal in as many days that India made. Was this one a surprise to you?
This one did come out of a little bit out of the blue. Now, this is not the same thing as the deal that India struck with the European Union. This is not a full-fledged trade agreement that was signed. This is more about de-escalating the tariffs that were imposed by the president. So this is a little bit of a de-escalation, removing some of those additional tariffs that the U.S. had imposed on India to try to calm things down and bring perhaps India back into the fold of the Western countries, away from Russia, and perhaps even a bit away from China.
Are there any parts of this deal between the U.S. and India that are still kind of unclear at this point to you?
Yeah, absolutely. So a critical part of that deal is reducing the tariffs. So the United States reducing the tariffs that it had imposed on India of up to 50%, which is one of the hardest hit countries, in fact. And so the idea is that the tariffs are going to come down to about 18%. Giving India a little bit of breathing room and a better situation compared to other countries. But the one part that's still a bit nebulous is this issue of India agreeing to stop oil purchases from Russia. And so that part doesn't seem to have been confirmed yet by India. They did confirm other parts of the agreement. But if that's the case, that indeed India is going to stop purchasing Russian oil, that's a major geopolitical shift because India is really the country keeping part of the Russian economy afloat and a major source of oil purchases from Russia.
And because of that, Donald Trump was saying that this will help to end the war in Ukraine. Is that how you see this kind of going?
It certainly increases the pressure on Russia, whether that's enough to get Russia back to the negotiating table and actually move the needle on getting Putin and Zelensky to reach an agreement is I think a live question. It probably is an incremental step, I would say, towards perhaps getting a little bit more bargaining power on the Putin regime.
When it comes to the deal India inked with the EU, it's been described, I love the description, a monster-free trade agreement. What do you make of this deal, first of all?
So that's a real free trade agreement. That is perhaps the largest concession that India has ever provided to other countries. This is a major removal of all tariffs for the future. So this is something very different than, imposing tariffs like the U.S. did and then scaling them back. This is a full-fledged trade agreement between the EU and India. Canada still doesn't have an agreement with India of this type. And so it really gives EU exporters a bit of a leg up. They're really the first to sign a comprehensive deal with India. This will mean that EU exporters, for example, in the auto sector, in the wine sector, a number of other sectors are going to really have free pass at the Indian market and able to really develop their exports, frankly, in a way that all countries are trying to do now, particularly given the impetus to diversify trade away from the United States.
Yeah, that's what I was wondering, right? Like some experts have suggested that this trade deal, at least between the EU and India, was because of these tariffs. Everyone's trying to diversify and look to other partners. We know, as you mentioned, Canada, Mark Carney is going to India in March. I mean, can we expect a deal between Canada and India potentially?
I think we're probably not quite at the deal announcement stage, though things are moving quite quickly. A free trade agreement like this the negotiations would have started a long time ago. This is not something that happens in a matter of months. These are multiple year processes. Normally, these free trade agreement negotiations, there's formal rounds of negotiations in each country. So I suspect this got started many years ago even, but probably reached a finish line a lot quicker than folks might have expected because of that need to diversify. So I think what Canada might do, I doubt that we'll be at the place of announcing the conclusion of the deal, perhaps if things get fast-tracked, but otherwise it'll be a good progress, barometer of progress between the countries.
So, okay, so then that's kind of what you expect when it comes to Canada and India meeting. I mean, relations have been frosty over the last decade or so, particularly in the last couple of years. Is this just kind of like a warming of relations?
Yeah, I think it's more like that. So Canada and India were actually in the midst of a free trade agreement negotiation a number of years ago, and for all the political reasons that you're referring to, those negotiations broke off. So we're kind of getting back into the groove of things, rejoining those negotiations, and engaging with those formal rounds. Having the negotiators on both sides. So I think that at this point, it'll be a really good signal that we might be able to get to the finish line on a deal, but I doubt it'll be about signing the deal at that point.
It's kind of like where Mark Carney stood when he went to China, right? Like there's a fine line to walk in terms of warming relations with that country, but also keeping the U.S. happy. Of course, I'm sure Canada is thinking about this free trade agreement with the U.S. and Mexico, the review coming up in the summer when dealing with countries like India or China.
I agree. I mean, ultimately, the Prime Minister's speech at Davos, to go back to it, is all about diversifying and having options for middle power countries like Canada. I mean, the Canada-India relationship is obviously a complex one, but from a commercial perspective, an economic perspective, is frankly way underdeveloped. The amount of trade between Canada and India is far too low for the size of our economies. And Canada has always needed to diversify and to bring more trade to India and agricultural commodities and technology. And there's a lot of low-hanging fruit there to improve. So this certainly makes sense as one of those places to start.
Okay, really interesting stuff. We'll have to leave it there. William Pellerin, international trade lawyer at Macmillan. Appreciate your time today. Thanks so much.
Thank you.
Coming up, Canadian facility maintenance company GDI has rejected a takeover bid from Birch Hill, and we'll get more on that after the break. Glencore Canada has been forced to suspend all investments related to emissions reduction and facility upgrade projects at the Horn Smelter, effective immediately. Glencore has been working with the Quebec government to secure the long-term viability of its operations in the province, but says despite efforts, the necessary conditions are not in place to allow it to proceed. Glencore says it remains open to other options to reduce short-term risks pending regulatory certainty. And shares of Novo Nordisk are trading sharply lower today after it said it expects profit and sales growth to take a hit this year. The drug maker says the expected decline is due to lower prices in the U.S., as well as loss of exclusivity for its blockbuster Wegovy and Ozempic in Canada, China, and Brazil. Novo has been struggling to regain its position as the leading weight loss drug maker amid fierce competition. And Disney has named Josh D'Amaro to succeed Bob Iger as CEO. D'Amaro is the current head of Disney's theme parks division and will begin his new role in March. The media and entertainment giant has been searching for 3 years to replace Iger and says he will stay on the board and serve as a senior advisor until his retirement in December. We'll take a quick look at the markets here. The TSX is down at the moment by 0.3%. It was up earlier. We're seeing it flip-flop a little bit today after some big losses last week, regaining that a bit yesterday. And if we take a look at the U.S. markets, all trading down at the moment. The S&P 500 down 1.3%, the Dow Jones down, and the Nasdaq down 2% at the moment. Two of GDI Integrated Facility Services' major shareholders have rejected a take-private bid from Birch Hill Equity Partners. And for more, we are now joined by Bloomberg's Montreal Bureau Chief, Mathieu Dion. It's good to see you. Thanks so much for joining us.
Yep, for sure.
This is interesting. So tell us about this rejection.
Yeah, so GDI is probably a firm you came across or a brand you came across. If you work in an office tower in Canada, the company says that it is the largest in the cleaning and maintenance services in the country. So big company here who grew through the past 2 decades through organically, but also through acquisitions. And that's the main argument put forward here by some of the investors opposed to this deal put forward by the CEO, Claude Bigras, and Birch Hill, that the bid should consider potential mergers and acquisitions down the line. So they are actually offering $36.60 per share for the company, which is a 25% premium from where the stock was trading in late December before the deal was disclosed. And its top holder of subordinate shares, MEDC, with a 15% stake, says it's not enough. It should be much more if you consider GDI's potential mergers and acquisitions. The investor said in a statement yesterday that it is unfair to shareholders and does not reflect GDI's intrinsic value or its medium and long-term prospect. So this was through a news release sent Monday morning. Afterwards, I sent some emails to some of the investors in GDI, and some came back to me saying that they do not necessarily agree with what's on the table right now. So you have Montrusco Bolton Investments holding 13% of subordinate shares that came forward afterward and saying that they do not support the current offer put on the table. They did not provide any other details, but they're likely to vote against it. Mauer Investments has not said what they'll vote on, but said in a statement that the recent profitability of GDI has been under pressure and is not representative of its long-term potential. Another large investor here, the Caisse de dépôt et placement du Québec, with a 9% stake, said that it is currently analyzing the takeover proposal. So that's where we're at. It's not clear what valuation would be best here, but some shareholders are not very happy with what's on the table.
Very interesting that they don't all agree. So then I wonder what happens next. Like, as you mentioned, the shareholders will need to vote on this. Is that correct? Or is there any word that Birch Hill might even try to upgrade its offer?
Yeah, so first, the vote is scheduled on February 23rd. What you need here to pass, the deal needs the support of the majority of votes cast by the holders of subordinate voting stock, excluding those who are going to roll their stock into the private company. So if you take Medici, Montrusco, you have 28% of subordinate shares here. Fiera Capital holds 12% of the shares. They didn't respond to a request to comment. You had the Caisse at 9%. So it's very unclear where this will all go. But Scotiabank was hired by the board of directors to conduct a financial analysis, and they came in with a fair value range of $32 per share to $37.75 for the company. The board chose $36.60. So maybe there's a way here to submit a new bid. It's unclear what's going to happen. Scotiabank was clear in its report that they did not consider mergers and acquisitions because each acquisition will represent a unique business and financial would have unique business and financial characteristic. So they put that aside. But yeah, interesting story that's playing out there. Now, shares of GDI are trading lower today, but still around $36, giving the company a market value of about $850 million.
That is very interesting stuff. Okay, Bloomberg's Montreal bureau chief, Mathieu Dion, reporting for us. Mathieu, thanks so much. Appreciate that.
Thank you.
Well, currency traders recently unleashed a sell-off that drove the U.S. dollar into its deepest slide since the U.S. trade war began. And despite some ups and downs, the downward trend seems likely to continue. Bloomberg News takes a closer look at that.
It's hard to overstate how big and fast of a drop this is for the U.S. dollar. The value of the dollar affects everything from the price of an iPhone when sold overseas to how much you're going to have to pay for that summer trip to Europe.
This story is about the global community losing its confidence in the U.S. dollar and quietly quitting U.S. assets, but this administration doesn't seem to mind it.
The dollar had its biggest drop since U.S. President Donald Trump unveiled his universal tariffs last April.
Donald Trump imposes the steepest U.S. import levies in a century, with China facing a tariff of more than 50%. The dollar is also weaker.
The dollar fell in a really big way against major peers: the yen, the euro, the pound, the Swiss franc. This chart over the past month shows just how stark the dollar's drop has been so far this year. The vast majority of days, the moves are very slightly up or very slightly down. But on January 27th, the dollar fell 1.1%. That large of a move accounts for about 1% of all days.
To understand the current dollar decline, we need to broaden the lens here a little bit because it is coming off very strong levels. Even at the start of 2025, the Bloomberg Dollar Index was hovering at near the highest in at least 20 years.
The foreign exchange market, or FX market, is where investors buy, sell, and speculate on currency movements. The scale of the currency markets is massive. On average each day, some $9.5 trillion is traded in the currency markets.
Despite rising doubts about the dollar, it continues to be the world's dominant currency and has been so ever since World War II. It is the most used in global trade, foreign transaction, the FS market, and it also accounts for the lion's share of global reserves held by central banks, even as that has come off a little bit in recent years.
A number of factors can affect the currency markets, but the primary force behind the dollar's fall right now is Trump. Fear has been fanned by Trump's unpredictable policymaking, including his threats to take over Greenland, political pressure on the Federal Reserve to lower interest rates, and tax cuts that have deepened the U.S. deficit. Trump has indicated he's comfortable with the dollar's decline.
No, I think it's great. I mean, the value of the dollar, look at the business we're doing. No, dollar's doing great.
His remarks underscore the lingering risks and the risk that global investors will look elsewhere.
It's becoming clear that tariff threats are being used as a negotiating tool on nearly every front, not just trade, and that casts a shadow over the U.S. economy at the time when growth is still fragile. If you look at the past 6 months or so, there has been little to no job growth in America, and that's largely believed to be the result of the trade war and the immigration crackdown.
The dollar's weakness has come despite a rise in Treasury yields and the Federal Reserve's reluctance to cut interest rates further.
For global investors who want to participate in U.S. stocks or play the AI theme, they may now be emboldened to hedge more of their U.S. dollar exposure given the dollar declines.
A prolonged and sharp weakening of the U.S. dollar brings with it a number of dangers for the U.S. economy. Trump in the past has made no secret of his desire for a softer dollar. A weaker dollar will boost American exports and promote American manufacturing. On the flip side, it makes imports more expensive for American consumers. It also comes at a time when there's sustained pressure on inflation from Trump's tariff policies. The U.S. has about $38 trillion worth of debt, many of which is owed to foreign countries, and a weaker dollar makes it all the harder to pay off that debt. The best case scenario is that a gradually weaker dollar ultimately does help promote American growth and exports. The worst case scenario is that a sharply weaker dollar ultimately leads investors to question the merit of investing in the U.S. That could lead to capital flight.
Despite U.S. stocks hitting record highs here recently, they've actually steeply underperformed global peers. And that suggests that investors don't have to sell America in order to hurt the dollar. They just have to buy less of it.
Trump's combative policymaking shows no signs of letting up. Still, not everyone's convinced that Trump's comments will lead to a long-term sell-off in the dollar. Major banks are telling investors to pull out and take profit on trades that wager on a weaker dollar.
We're already seeing the dollar rebound here a little bit, and that's likely to continue in the short run. After all, President Trump has already walked back some of those tariff threats, and the U.S. economy appears to be improving. However, uncertainty will linger, just because you never know when policy risks flare up again, and global investors will want to be protected against that. So we may be headed in this very unusual situation where the U.S. economy does okay, the stock market is okay, the dollar not so much.
Bloomberg's reporting shows a real fear of de-dollarization among U.S. and international investors. And while there's a lot of reasons behind that fear, it's also been proven it will take time to play out.
Coming up, AI startup Anthropic is releasing a tool designed to automate legal work. We've got more on that when we come back. Stay with us. There has been a sharp sell-off across data and legal services stocks today after an AI startup, Anthropic, released a new corporate productivity tool. So For more, we are now joined by Rudy DeFelice, Global Head of Harbor Labs. Rudy, it's good to have you join us. Thanks so much.
Yeah, I'm delighted to talk to you, Lindsay. It's another exciting day in legal technology world.
It really is. I mean, this tool introduced today, it's caused a ripple effect across North American markets. Why are markets reacting like this in the wake of this news?
I think there's recognition that the foundational language models present a long-term threat to some of the SaaS companies and traditional research companies. Today, I think premier legal organizations wouldn't swap their enterprise-wide tools for language models for most applications. But I think the market's starting to see that day is coming when the challenge is going to be a little bit more significant.
Okay, so let's backpedal a bit. For people who are not within this industry, what does the Anthropic legal plugin actually add to the market? What is it?
Well, Anthropic has enterprise subscriptions, and they have this co-work environment in there. And within the co-work environment, they have certain domains that they've built specific workflows. So they have finance, marketing, sales. They've just added a legal plugin. And what the legal plugin does is it allows people to do legal activities on the foundational model of Claude. So, if someone has a contract they want it summarized, or they want to extract certain fields from it, or they have some workflow where they want something to introduce a process that has, kind of legal resonance, they're able to do that now.
So interesting.
And that's what many of the traditional tools, and even some of the new AI-specific tools, specifically Harvey and Legora, which have been getting a lot of news lately, they've developed really sophisticated products in this area, which have tremendous market capitalizations, and they're, to some extent, I think, running behind those products.
I mean, it's been interesting to see the reaction to this introduction of this tool today, right? There's a number of Canadian tech companies that are down because of this, but also Thomson Reuters, for example. We were watching this company today. It's down, last I checked, 19%. Does this just show how important competition is within these different companies?
Yes, the legal technology space was considered a little bit of a backwater in the broader technology world, but because of AI, which is so specific to what legal organizations tend to do, what we do in legal is digest large amounts of information, reason, and create output. And LLMs are very good at this. So there's been a lot of focus on what the impact on the industry is going to be from language models. Yeah, it's tremendous that TR is down, as you said, up to 19%. Seems like an overreaction to me. There was also kind of an analyst warning, so I think those two things in combination probably led to that. But LexisNexis, which is a competitor, their parent company's down somewhere in the mid-teens, and Wolters Kluwer, one of the other big three research companies, is also down in double digits. So it's a pretty significant movement in a single day. I believe it's a bit of an overreaction, but I think it's a signal that a change is coming in the legal space, and that the traditional companies are going to have to evolve.
So interesting. I mean, if you think it's an overreaction, then obviously we'll see a bit of a correction here with some of these companies, I'm sure.
Yeah, it's a tremendous drop for one day, and nothing really fundamentally has happened to these companies other than what the future might hold. And I think there's too much unwritten, too much changing too fast to predict that kind of drop in the enterprise value of these companies.
So why is Anthropic doing this? As you say, is this just the future of this industry?
Yeah, I think the foundational legal models, OpenAI, Anthropic, they recognize that they've got a tremendous core product, and that the revenue models are going to exist in the enterprise applications of those models, kind of on the periphery of what the fundamental language model does. So they want business users to have some specific solutions that relate to them. So this co-work environment, which Anthropic charges for, they're making it more compelling by adding the kind of business functions that most enterprises tend to do. Now, I don't think that they feel that this is going to put the Harveys and Legoras out of business, because they build very elegant, specific things for premier legal organizations. But for general enterprise users, commercial users, smaller organizations, these tools are super valuable, and I think it locks people into the platforms.
You touched on it.
Intelligence is being commodified. So to the extent we could make this legal intelligence free for smaller organizations, it probably has a societal good as well as a real kind of enterprise value for Anthropic.
You touched on it, but I'm wondering in our last minute if you could just explain like what this means for users and how people will be able to actually use it.
Yeah, so I think a general commercial user who is involved in a business deal can first draft of a contract. If they received the contract from somebody else, they can have it analyzed against a risk profile that they have to maintain. They can create first drafts of things that have kind of legal flavor in ways they couldn't before.
Okay, very interesting stuff. We will leave it there. Rudy DeFelice, Global Head of Harbor Labs. Really appreciate you joining us today and breaking down what we're following. Thanks so much.
We're glad you're reporting on this. Thanks for having us.
Thank you. Well, still ahead, today's Market Movers with Bloomberg's Matthew Griffin. That's right after the break. Join us this afternoon at 3:10 Eastern on commodities. We will be sitting down with the CEOs of Foreign Mining and Eldorado Gold to dig into Eldorado's acquisition of Foreign in a move to create a leading gold and copper producer. Again, that's at 3:10 this afternoon Eastern time. And for some movers south of the border, we are now joined by Bloomberg Equities reporter Matthew Griffin to break things down for us. Matthew, it's good to see you. We're going to start with PayPal, of course, reporting earnings, moving their CEO, and now this company, the stock price down almost 20% at the moment.
Yes, PayPal, their shares are plunging today on a couple of events, but events that are very closely related. So the headline news catching investors' attention, the company has replaced CEO Alex Chriss. The CEO who will be stepping into that role is Enrique Flores, the CEO of HP Inc. Now, the reason that they are doing this is that a turnaround effort at the company has been seen to be stalling out, and we got numbers out of the company as well today that seem to confirm that narrative, revenue, and profit that missed estimates in the fourth quarter. Under former CEO Chriss, the company had recommitted to its branded checkout experience as part of that turnaround effort, but growth actually contracted sharply in the last quarter at that part of the company. Really not what investors were looking for, clearly not what the board was looking for either. But this strategic change has not been greeted positively on Wall Street. I was just looking at comments out of Evercore ISI, which says the company is trying to run the same playbook now, expecting different results after the last pivot didn't succeed. And they say that even where the shares are now, after what's looking like their worst day since 2022, this stock is dead money.
Wow. Okay. On the flip side, you're also watching FedEx, which is up almost 5% at the moment. What's going on there?
Yes, FedEx is extending a rally, actually set an intraday record for the fourth straight day today. The most recent gains came after the parcel carrier won two new bulls on Wall Street. That's at Wells Fargo and Bernstein, upgraded the stock to buy equivalent ratings for a few different reasons. For one thing, the U.S. economy is strong for shippers of goods right now. You have a strong growth outlook. Investors have been piling into transportation companies in general. FedEx also looking to shake things up at its business in France as it looks to grow profit in Europe. They're going to streamline those operations, cut some redundant areas, make some other investments to try to compete. Wells Fargo said they expect strong targets at an investor day next week. So a lot going on that's making analysts bullish. This stock now up roughly 50% since the end of September on those economic hopes that cost-cutting plans at the company are taking fruit, and broader strength in transportation and industrial stocks.
You're also watching Walmart today. This is super interesting, joining the $1 trillion stock club. And what I think is interesting is Walmart's actually the first retailer to be valued over $1 trillion.
Yes, and Lindsay, Walmart is one of the few companies at all to be valued over $1 trillion outside of the tech sector. Of course, talking U.S. dollars here. You look at Berkshire Hathaway, for example, one of the few other examples. Now, to some extent, that's actually because of technology investments that Walmart has been making. They've been using AI in their own business, for example, supply chain management. And they've also been rolling out AI-enhanced shopping experiences for customers, partnering with Alphabet, the Google parent, and OpenAI. But they've also been running their core retail business well. They've used their scale and their supply chain to keep costs low. That's as competitors have been raising prices and consumers becoming more price conscious. Really a positive move in the environment we're facing now with tariffs, and that's paying off. You got the stock up more than 2% today in the $1 trillion club.
Okay, that's all the time we have. Matthew, appreciate that so much. Thank you. And that wraps up this edition of Trading Day. Thanks so much for watching.